There's a lot of information out there on investing through your retirement accounts. And this is why it's so important to make sure you get the correct, accurate information out there. I'm so excited to have Matt Sorensen on the show today because he is an expert. He is a pioneer in this. He's written multiple books. He has multiple podcasts. He's helped on the government level with informing how they are structuring things. He knows what he is talking about. And conscious investor, I like to have people that I'm confident are going to guide you in the utmost best direction. So in this episode today, we're going to talk about, how do we invest through our retirement accounts? Who can do this? And what retirement accounts can we invest through? Which accounts are eligible? And really, we get into the nitty gritty as to should you use your retirement account to invest, or is there a better way? And that last part really struck a chord with me because that part of our conversation, we really dive into the pros and the cons of using your retirement account to place investments. I really appreciate Matt. He has a lighthearted nature. I love that he uses the office as a way to demonstrate understanding on this. Like, it's very relatable. And I love that he's really looking out for your best interest. Be sure you head over to Directed IRA because you can learn more about how they operate. And they are a powerful, powerful company when it comes to helping you with your self-directed retirement accounts. But you can see through this episode that it's not just about like, oh, we can help and we are the best at it. We want to help you in the right, appropriate way for your best interest. And that right there is why Conscious Investor Matt is on the show. We want people on the show who are looking out for your best interests more than their bottom line. So I'm confident that when you go to Directed IRA, that you're going to get counsel and advice that's really going to steer you in the best direction possible. Let's dive in. Matt, so excited to have you for a second time on the Conscious Investor podcast. That does not happen very often. So kudos to you. I want to dive on in and say, what do you do and how did you get started?
Yeah, well, let me just say thanks. Two-time podcast appearance, Matt Sorensen here. Super excited. I mean, I think the easiest way to say who's Matt Sorensen, I'm a wealth lawyer. I'm a dad, husband. I like to hold hands and take long walks on the beach. But most of what I'm doing is around how to build wealth, whether as a business or tax lawyer in my law firm. We got 4 offices, 60 plus employees there, helping clients plan to save taxes and build their wealth in a tax efficient, how to preserve it, asset protection, and then how to pass it on. And then the other side of my life is spent helping people use their IRA or 401k dollars, like the $33 trillion in US retirement accounts. Most people think I can just buy stocks, bonds, and mutual funds with that. No, you can actually buy real estate, invest in private companies, private funds, lend it, buy crypto. All these alternative assets are actually investments you can make with your IRA or 401k. And that's what we do at my company, Directed IRA. So that's at least kind of business, Matt, there, at least the details there. I wrote some books, I write articles, I got events. I mean, I'm out there. I got another business, Main Street business. It does corporate compliance. That's the short and sweet of it, if that was short. Now, by the way, I'm a lawyer. So for any of you that are new to Matt Sorensen's, I've billed by the hour for 15 years. So sometimes I can get a little long-winded, but that's the short and sweet of it.
It's a good thing. Don't send me a bill for this one.
There'll be no clock on this. That'll help me get to the point.
No clock. It's amazing.
The billing meter is not running today. So,
Amazing. So concise with your words. It's amazing. Okay. So obviously we already know that you're lazy, you're complacent, and you're not ambitious at all. You don't like having multiple on. I mean, enter lots of sarcasm, conscious investor. I know you do that. But how how did you get started? Where did you even start with this? Like, self-directed IRAs in particular are something that people didn't even know about. It's really hitting
Yeah.
the last, I would say 7 years has really been when it started to really hit mainstream.
Yeah.
But how did you even get started on this path as attorney turned I mean, like,
Yeah. Yeah, I mean, it's been an awesome journey. We just started a directed IRA 5 years ago. We have 1.5 billion in assets, 15,000 accounts. We open 35, 40 accounts a day of new people opening up an account, going off of Wall Street, so to speak, to invest in real estate or some alternative asset with their IRA or 401k. So we've been on the Inc. 500, Inc. 5000 list at number 813. I mean, we've grown and scaled exponentially. It's been an awesome ride. And so, but I got into it just as a tax lawyer. I mean, I had a client that just wanted to buy real estate with this IRA. And I was like, I didn't know you could do that. And he was pretty confident. My law firm partner at the time, he's still my law firm partner, but just back in time, I mean, here, Mark Kohler, attorney at CPA, was like, oh, yeah, you can do it. I've helped some clients do it. And I was like, really? I'm like, they didn't teach this in law school, wasn't on the bar exam, didn't hear a peep from it from Wall Street about how you could do this. And so I just kind of thought it was interesting. And as I got into my legal career, I was representing a lot of real estate investors, had a lot of real estate developers, contractors, private equity investors, small business owners. These are all entrepreneurial people who, when they think of their retirement account, don't get excited because all they think about is a mutual fund. And I'm like, wait, guys, you don't just have to buy a crappy, boring mutual fund. I mean, if you're good at that and you love that, knock yourself out. But my entrepreneurial clients were like, can't I use this IRA, this Roth IRA or traditional IRA or my old employer 401k? Can I use it to invest and grow a retirement account in something I actually know, like real estate or small business or any of these types of things that they're already interested in and do? And so it's just a perfect fit. And so we just started teaching that. I started speaking at conferences about it. I started with like the realtors, and then I got to national conferences. Then I wrote the #1 book on it. I'm on a bunch of boards in the industry for self-directing. And so I just kind of grew my brand around using your IRA or 401k to invest in real estate or all alternatives. So, I mean, it was a journey though. I mean, that was like 2008, I would say, when I was like, all right, I'm going to really start this. There was no book on it. There's no podcast on it. By the way, I have 2 podcasts. One of them is on just self-directing alone. So I just dove deep on it and just loved it. I self-direct my own retirement account. I do this with my own dollars. And so that was just kind of the journey of it. And now we've got the fastest growing self-directed IRA company in the industry. And I got a law firm that supports a lot of those clients too.
I love the journey and the trajectory of it. What's interesting, Matt, is that you and I know that there are a lot of um, bozos. That's what my dad would say. There are a lot of right? And they set up these firms, and when things seem easy and it seems like a quick buck, like everybody is showing up at the pool, ready to.
Mm-hmm.
And yet you've you wrote the first book on this
Yeah.
topic. You've been one of the front runner on the topic, really being the pioneer of this. What are some of the things that you're noticing? Because let me preface this also. I also get to see with my passive investors a lot of different self-directed companies out there, and they are
Yeah.
all equal. And so you've seen the influx of
Mm-hmm.
those enter the market, and we'll just call I mean that in a kind way. It's just people that they think they know what they're doing and they really don't. And
Mm-hmm.
it's misguided. So how can we differentiate? Like, what differentiates directed IRA from
Mm-hmm.
the elementary stage people?
Yeah, I mean, I think it gets down to just execution at the end of the day. And a lot of, I mean, there's companies in my industry that raised $100 million. Like literally, they have 100 million plus valuations. There's one that raised, 40 million at 100 million valuation just in the last couple of years.
Mhm.
And everybody's like, "Ooh, this is a hot area," and they want to fintech the heck out of it. And um, but we're crushing them. We're crushing them. And the reason we're crushing them is just execution. And I don't care what business or industry you're in. It could be the oldest businesses in the out there. Let's say real estate, not the other one. But it could be so those business. It's execution and how you get it done. Sure, strategy matters. You got to have the right strategy, of course. And as an industry expert, I feel like I have the right strategy. But that's not the hard part. You have to have that. The more difficult part is executing on the strategy every day. And that's where the companies in my space that I compete against every day fail. And that was our opportunity in the market. I mean, really, I was referring 5 clients a day. Like literally, I would get at least 5 emails a day of someone that's like, I read your book. I want to self-direct my IRA. Who do you recommend? Or I got referred to you from so-and-so. Who should I open up my account with? And I would send them out to all my current competitors. I was just dissatisfied with the service they received. And I was annoyed, frankly, that I had to do so much handholding for these clients to tell them what form to fill out with that company that they pay for that service. I don't even get paid for. And so I was like, just annoyed. So I'm like, we can do it better. And so I really think what sets us apart from any of our competitors is execution. I mean, we have great pricing. We have the right strategies that clients want to use to self-direct, but it's the execution of it, just how you get it done.
You have the kindest people on staff as well. And I know that a lot of times I will hear passive investors, and investors in general talking about price. And
Mm-hmm.
I definitely overpaid for a lesser quality product.
Yeah.
I didn't know what I didn't know. And now it's like, yeah, that I'm glad that there are other options. I'm glad directed IRA exists, and
Yeah.
staff, just a seamless process and easy onboard, everything. It's just amazing. So I love that, just being an industry expert and front runner and everything, on this topic. What are some of the elements that you are seeing right now? Let's come up to current modern times, right?
Mm-hmm.
Current present day. People aren't always doing the right things with their self-directed funds. What are some things that you're seeing that are scaring you about self-directed space that people should be like, no, don't think that you can do that?
Yeah. I'll say that, I mean, it's the internet that scares me. And when I say internet, I mean, like an old person, I mean social media too. Like, there's just so much misinformation out there. And even when I wrote my book, the reason I wrote my book, which is the Self-Directed IRA Handbook, the #1 book in the space, the National Association of the Industry uses it, regulators use it, the Government Accountability Office that a report on self-directed IRAs use my book. And so it's got over 100 citations. It's like legit. Okay. This is like the book in my space. But um, there's just so much bad information out there. And that's why I had to go write a freaking book. Like, I didn't want to write a book. I mean, it was an opportunity to build my brand, but like people needed guidance about what was legit and what they really could do with their IRA. But there's really 2 categories where people screw up with a self-directed IRA. One, they don't understand the rules and what they can and can't do. Like, oh, I want to buy real estate. And then they go stay at it. Well, you can't do that. The retirement account can own real estate for investment purposes, not for personal use. And so, but there's just little blunders like that people make. um, some classic blunders that I should say that people make. That's what movie is that? Wow.
Oh, I
Help
wish.
me out. Classic blunder. Classic blunder. I'll come back to it. It'll come to me. Someone listening knows the movie I'm talking about. Anyways, they mess up the rules. The other category is they get the rules right. They know the rules even, and they go make a dumb investment. And so self-directing, on the one hand, it opens you up to a greater opportunity of huge wins, right? You could be like Peter Thiel, right? The guy has a $6 billion Roth IRA that he self-directed, right? He used his IRA. He was the first outside investor in Facebook, and invested $500,000 approximately. It ended up, worth over $1 billion itself. He's invested some other things, but he invested in basically startups back when no one knew of what they were. But that was what he was good at. That's what he knew. And so, but you could be like Peter Thiel, and you could have invested in MySpace, or I don't know, they probably got bought out, but something that went nowhere. And so, while there is greater opportunity to make home runs, there's also not opportunity, but there's also the risk of striking out. And so you got to be careful in how you do that. I'll give one example. I do an alternative asset summit every year now. We did our first one last year, at about 350 people there. By the way, you should come to that. It's going to be in Phoenix in October. We'll have to talk later about that. But I had one of the speakers there. Her name was Lisa. I forget her last name, but she's an angel investor in Southern California. She runs the Tech Coast Angels chapter, which is Tech Coast Angels is a big angel investor network. They invest in startups, angel investing. And she basically said, in angel investing, for example, you have to invest in 10. If you take your IRA and invest it in one company, the most likely outcome is zero. If you put 100 grand into that one company, the most likely outcome is going to be zero. You have to invest in 10 in order to have one or two winners, a couple break even, and the rest are going to fail, because that's angel investing. So you need to learn those investment assets. Don't get excited. Don't just see something on social media, or, or you got to do your research and get educated and learn that stuff. So just making a bad investment could be kind of the other category, I would say, though. That just takes education, and sourcing deals too. How do I source deals? How do I find them? How do I meet people? It's not like a ticker symbol. You're just going to click in on the computer to go buy. Oh, I'm going to buy the S&P 500 fund. SPY. I'm going to go buy Microsoft. I'm going to, whatever. It's different. You got to go find this stuff.
And then you have to vet everyone. This is,
Mm-hmm.
I'm just going to double down and completely agree with you on this, because there is a demographic where they like the idea of self-directing, but they're not going to do the work, because it does take work. That's why you're self-directing, you're opting into, I'm going to do the research. I'm going to vet this deal. I'm going to source it. I'm going to run all and bear all the risks. I mean, there are risks either way, but it is a lot more.
Yeah. Totally true. And even just in our accounts that we see it, actually the number one most popular investment that we have at Directed IRA, as a category at least, is private funds. Why is that? They're interested in self-directing, but they don't want to do the work. They're going to do the work to at least find a private fund operator, but they're not going to go run a deal. They're not going to go do the whole thing. And they want to have some nature of being passively involved. Yeah, I got to go find those deals. I got to go vet those investment sponsors, those people running those funds. But I'm not doing it once the money's in. You know what I mean? Then I'm in it for 5, 10 years, or whatever the timeline is. And so that's the most popular investment asset that we have as a category. But what I'll say, though, is and those accounts can do very well. The largest accounts that we have, and I have a client with a 300 million plus Roth IRA. I have a couple others in the 100 millions and a number in the 10 million plus. Average account here is like 100 grand, though. I don't want people to think like, oh, you just talk to these people. I got some big ones, but there's 15,000 of them. Okay. We got a lot of smaller accounts and a medium in the 100,000s. But the largest accounts, they're doing the deals. That's where you get a huge home run win, right? You take all the risk, you do all the work, you're outsourcing deals, you're doing all that work. That's where you've seen clients get the bigger returns. And so those are the clients that have the really, really big accounts, as they're running their own deals. Typically, they have some expertise already, whether it's in real estate or in a private business industry where they're investing, and they're just hitting their niche and just crushing it, frankly, every day. But that takes work. That's for like the larger account. That's like their full-time job. That's all they do, is they're in that space doing that every day. The typical self-directed investor is not doing that, though.
I think that somebody should be self-directing. It's total, obviously, your opinion. And in Conscious Investor, you hear me say on the podcast all the time, there's a difference between opinions and advice. So I'd love to have your opinion, or if you want to give advice, you can. But is there anyone that should just simply feed their IRAs and just leave it? Or do you think this is a good option? And I know that's kind of double downing on the same topic, but
yeah. Well, first of all, I don't think self-directing and using your IRA to buy real estate, alternative assets is for everyone. It's not. I mean, first of all, if you're not interested in it, why do it? And really, you can go do a much easier job and just go buy a mutual fund. Just go buy the S&P 500. That's what Warren Buffett says. He's like, hey, even the hedge fund people can't beat the S&P 500. They're doing this every day, providing all this technology, hiring all these rich people, expensive employees from Harvard and all these Ivy League schools. They can't beat it. Just go buy the S&P 500. And I'm like, that makes sense. And I go into the S&P 500 when I'm between deals and such. And so for a lot of people, that's fine. And that may be what they want. They like that, But I do think a lot of people want to be more connected to their money. And for so many Americans, most of their investable capital is in their IRA and 401k, and they want to be attached to it. And they're like, you know what? I own a couple rental properties, or I go to, I speak to realtors all the time. I'll be like, and these are successful realtors, you know. I'm like, anyone here tell me a good mutual fund to buy? Nobody raises their hand. Does anybody here know a good deal on a real estate investment deal that you could put some money into? Half the room raises their hand. And I'm like, why are you guys all buying mutual funds with your IRAs and 401ks? You're in the business of this every day, seeing deals and opportunity. Like, you have this superpower of like deal flow where you make money in the real estate space and you see deals and opportunities. You should be using your investable assets, your IRA or 401k, to go do those deals. And so depends on the person. What I said, the earlier part, I'm always like dealing with entrepreneurial people. Yep. If you're an entrepreneurial person, you're typically a good self-directed investor. You can make decisions. You like to cut deals. You can negotiate. You can diligence a person, you know, and make a decision. Is that someone I can invest with or not? So I think everybody kind of depends on what you're doing. But even within the self-directed investor, like the example I gave of the peak clients with the largest accounts are doing their own deals. They're sourcing their own deals. That's not me. I got 150 employees. I'm scaling businesses. I'm busy in my career and my family and stuff. I buy single family rentals and do private money lending at 12% interest. Like, it's very passive. I'm not flipping a property. I'm not going to go do a multifamily value add deal. That's a business operation when you get into that stuff. I'm doing the layup easy stuff. It's not S&P 500, but it's not doing a complicated deal that could drive more return, but it's going to take a heck of a lot more time and effort.
Mm. That's a great differentiation there. Now, curious question. I've had some investors who have wanted to self-direct their IRAs, and then they enter into the process, and I will say, this happened not with your company, but I don't think that it was a company issue. I think it was their own personal issue. So let's just clarify, what can we self-direct?
Yeah. I mean, any retirement account can be self-directed at some point. So if you have an IRA, you can always self-direct. Roth IRA, traditional IRA, SEP IRA, I don't care if it's Fidelity or TD Ameritrade or your local bank or credit union, doesn't matter. You can self-direct it because it's already in an IRA format. So you can roll it over from, or it's called trustee to trustee transfer, actually, from, let's say, TD Ameritrade over to a directed IRA. The problem is your IRA at TD Ameritrade, they're a broker dealer, and they're going to be like, well, your IRA can invest in what we sell here. We're a broker dealer. You can buy stocks, bonds, and mutual funds. You're like, well, I want to buy the rental property on 123 Green Street. You can't do that. And it's not because IRAs can't do that. It's because TD Ameritrade IRA can't do that. So you need to move to a custodian that lets you do it like directed IRA. You can move the whole thing or just a portion of it. But IRAs, you can always move. 401ks are where it gets complicated and confusing. I always like to use The Office to explain this. So if you've seen The Office, right, you think of Office. Jan. Yeah, okay. Jan got fired, quit. I don't remember the facts exactly, but if you remember Jan, Michael's boss, they dated. It's hilarious. But okay, she was in her 40s. She was working there, but then she got quit or fired. So she's no longer an employee at Dunder Mifflin. When you have a 401k with a prior employer, think of Jan from The Office, you can roll that money to an IRA. You could go to TD Ameritrade, you could go to directed IRA, you can go to any IRA company you want. And you just roll that 401k out. And this could be same if you're a government employee with a 403b. Now, let's say that you are Jim. Okay, everybody loves Jim. And okay, Jim's in his 30s, I think, in the show. He's got the 401k there. Now, Jim, because he's an existing employee at Dunder Mifflin, he cannot move the money. All right, he's typically stuck now. There are some exceptions. I can come back to that. But in general, if it's a current employer 401k where you still work, they're going to be like, oh, the Dunder Mifflin 401k, we use Vanguard. You got to use Vanguard. And as long as you're employed here, you can't move it. It's stuck at Vanguard. And so that can happen with a current employer 401k. That's very common. Now, even if it's a current employer, but you've hit retirement age, you can move the money. So for example, you can take Creed, right? Creed's, hopefully everyone's listening has watched The Office. Otherwise, this makes zero sense.
We love this show.
Okay. All right. Okay. So Creed, right? By the way, Creed has a band. I don't know if you know that, but Creed has a band and he performs at like local concerts. My daughter saw him in concert in San Francisco. Isn't it hilarious? But anyways.
Oh my gosh, I did not know that.
Yeah. He's apparently a very interesting multi-talented person. So in the show and in life, he is over 60. And so he's over 59 and a half, the retirement plan age. So even though he's still employed, let's say he has a $400,000 401k, he's been putting in it for a long time, he can roll the whole thing out and go to a self-directed retirement account. So the one where people get stuck is they're like, man, I'm 40. I got 300 grand in this 401k, this company I've worked for a while, but I'm stuck. I can't move it. And that is true. You will get stuck. Now, there's some exceptions to that. There's something called an in-service rollover where there's a portion you can move out, but that's where people do get stuck sometimes.
Yeah, they're definitely, I come across a lot of people in those middle years, the betweeners is what I like to call them. And they're just, they're betweeners. They are stuck. Is there something about being vested, like fully vested, that you'll be able to pull some out or anything along those?
So let me hit the exceptions to that. Okay. I'm like, this is where tax lawyer, Matt, you're going to lose people on a podcast. Okay. Now there's exceptions to that rule. The first one is employer contributions that are fully vested. Employer contributions that are fully vested can be rolled out under the tax code if the plan allows it. Now the plan could restrict it, but actually there's a survey I saw that 60% of plans do allow this in-service rollover for vested employer contributions. Now it's weird because you would think, well, I'm the employee. When I make my employee contributions to the 401k, I should be able to get those out. Nope. The way the rule was written is it's actually the money the company put in for you that is vested that you can pull out even while you're still working there, even before you hit 59 and a half. So that's the first exception, is vested employer contributions. The second exception of where you could get money out, this is current 401k, you're in your 40s, 50s, whatever, you're not retirement plan age yet, still work there, is if you rolled over an IRA or another old employer 401k into the new 401k. Let's say you worked at XYZ company and you had 100,000 401k. Now you're working at ABC company. The XYZ 401k goes into the ABC of 100 grand. You could move that 100k out later on into an IRA, even while you're still working at that new company you're at, the new 401k. So those would be the two exceptions: an old company 401k you rolled into a new company 401k where you're still employed, or vested employer contributions.
That's really interesting. I didn't understand. I haven't gone down the rabbit hole on that, but it's almost like it's transient. Like, okay, my old can kind of transfer wherever it wants to go, however it wants to go.
Yeah. And sometimes there's like logic in the tax code. Sometimes you could think of it that way. That makes sense. Like the old employer 401k, it's still transient and it was earned somewhere else and just rolled into this plan. So it makes sense. You could roll that out. The employer contributions, I think the rationale behind that was, well, this was meant to be additional compensation to the employee that we paid them and it just got stuck in the 401k. So we will let them roll it out early, at least to an IRA of their choosing. I don't know. It's always hard to figure out what the heck Congress was intending when they wrote these rules, but that's what they are. And I think that now the hard part is, let's say you are that. Let's say you're like, and I had this executive at Wells Fargo. She was very high up in the food chain, like on the public, the 10Ks and everything. And she was she had about 600K she was trying to get out of her Wells Fargo 401k. She was in her early 50s, wasn't yet at retirement plan age, and the only reason she was able to figure this out and get the money out of the plan was not because of me. I mean, I've helped figure out you should be able to get this out, is because she raised hell with the plan benefit provider and HR to get it out. They're like, no, you can't take it out. Nope, you can't take it out. Everyone told her no, but because she was like their boss's boss's boss, she was able to go down and be like, the hell, that is not the right answer. And she got the answer and was able to roll this 600K out to a self-directed account because you want to do a real estate deal. And so sometimes you're going to need to push against the typical question of the frontline customer service person at your 401k provider, your current job, that says, oh, you're still employed, you can't roll any money out. That'll be a 10% penalty. It'll be a distribution. You can't do that. You might have to push past that and say, do you allow an in-service rollover? Are you sure there's not an in-service rollover? And I always like to ask, do you have an in-service rollover form? Because then they're like, oh, maybe we do have this, like, because there's usually a form for this. It's a specific form with a little disclosure and everything on it. So that might be some tips for someone doing it, is if you are in that scenario with current employer 401k, we're trying to pull out some piece of it, ask for in-service rollover, ask about an in-service rollover form. You might have to overcome a couple of no's to get to the right answer.
I think that might have to is actually like, if you don't face some level of resistance, that's miraculous. Because most investors I have worked with who have gone down this path have faced resistance. And I always like to say, why would they want that money? They want to leave they're the custodian of it, and they are making money off of that money. They don't
Exactly.
use that money. And so they're going to make it excruciating for you to go through the process and make it really scary and make you think that bad things are going to happen and that you're stupid and you don't know what you're doing. Like,
Right. Yeah, exactly.
like,
Yeah. And they want you to stay, right? They make money when you stay. I mean, that's what you're up against. And so you just got to be persistent. And I hate to say it, but kind of a pain in the ass, but do it nicely. All right. Do it nicely. I always think you get better results that way.
It goes back to the old adage, squeaky wheel gets fixed every time. So conscious investor, if you're considering this, you want to go to directed IRA, you want to work with a company that knows how to support you through this process, a company that is based on integrity, and they're going to put your best interest at heart. Matt, I want to go to bonus depreciation. Here's a question.
Go to what?
Bonus depreciation.
Oh, okay. All right.
Question that I get asked regularly. And we're, entering into, tax season, really. I know that it's going to come up often for a lot of people. And they're going to say, what do I get to do with my depreciation? I invested through my self-directed account. I have this, maybe it's just regular depreciation. Maybe I have some bonus depreciation that I accumulated from some investments last year. Do I get to use that on my personal? I mean, I used my self-directed IRA to place this investment. So what happens with my depreciation?
So IRAs don't pay tax. So you still get depreciation. And that's what I tell people, because a lot of people get hung up on this, is IRAs don't pay tax. So there's nowhere to use the depreciation. So when you think of like your IRA, the income you're making on that is not going on your 1040. When the property sells and there's a gain coming through or there's rental income, it doesn't hit your 1040. So you're in this no tax zone here, particularly with the Roth accounts, because it comes out tax-free. So there's no depreciation. You can't use it. There's nowhere to put it. So I don't think that's actually a disadvantage. I think that's the whole point of retirement accounts is, hey, we'll let you invest this money. I don't care if it's a mutual fund or stock or real estate or a private company. Don't pay tax on it. Go grow it. Every dollar you get to reinvest. You don't pay taxes. We let this float off of your 1040. It's not even hitting your tax return. Then people are like, but if I buy real estate, I don't get depreciation. What? Why do you care about that? You're in this no tax area world where depreciation doesn't matter. You know what I mean? So I wouldn't get too hung up on it. Now, some people are like, but I want to use the depreciation to offset other income. Okay, do that with your personal money. Go buy other real estate, So it's kind of like you're trying to use two tax strategies at once. You're like, well, I want to use the retirement account that lives in this no tax zone, but then I also want to get depreciation on it. It's like, you don't get both. I mean, you can have both, but just buy real estate personally if you want to take depreciation. And so, but that's like me, I own a lot of real estate personally. Now I'm not a real estate professional, so a lot of my losses don't really help me anyways. So it really only helps for real estate professional or your spouses. I also use my retirement account to buy real estate because I think it provides a better return on investment. I think the cash on cash and the appreciation, the value of the assets and the income it can produce is better than a stock or a mutual fund. I'm not buying real estate with my retirement account because I'm interested in depreciation. I don't know if that helps.
Oh gosh, Matt, really seriously, it helps. Conscious investor, there is a lot of misinformation out there on this topic. And so those where you'll hear people say, well, you can't use it to offset, because it's not a 1040. So we can't use it over in our self-directed space, but you can use it on your personal. I have heard people say, no, but you can use it on your personal income tax to offset that.
No, definitely not. And because the IRS is like, this has nothing to do with you personally. Like, oh, you want to put that on your personal? Are you going to put the income on it on your personal return too? And if that's the case, why did you use your retirement account? I mean, this is like, again, where two tax strategies are colliding and people are trying to use the two at the same time. The podcast, this isn't helpful, but on video, I'm gesturing with my hands too at the same time. It doesn't work. So, and that's, in my law firm, we have a tax law firm, we have 14 lawyers doing tax and legal consults all day long. And we get pretty deep on this. But at the end of the day, I think clients need to take a step back and be like, all right, depreciation is nice on real estate I'm buying personally. I like that, right? I love that expense. It can offset some cash flow and income I have on the rental income. Maybe I'm a real estate professional. I can, if I'm getting even a bigger loss on the K1, I can use it to offset my personal income or my business, whatever it may be. But when I'm using my retirement account, I'm looking for return on investment. I'm looking to get the greatest return possible. I think it's more important to focus on that and take depreciation off the table. How am I getting the biggest return to have the biggest retirement account? So I have a retirement I'm actually looking forward to when I hit 60, not what I'm scared about. And I think if you're focused on getting a higher return, that's where you're going to see value. And, you can do all the projections, get on a calculator, your annual return on your investment. Going from 8% to 10% is huge on what your account's going to look like in 20 or 30 years. I mean, it's like double the difference that you're going to have. And so if you can move the needle just a couple of percentage points on return, that is huge in terms of what your retirement account is going to be at the end of the day when you think of investing over 10, 20, 30, 40 years, which is what most people's horizon is when using an IRA or 401k. So careful on getting too caught up in the details and some of these tax issues. Yes, you need to know them. Yes, I love the depreciation strategy on real estate for personal ownership, but don't get dissuaded by that or confused in that being a negative to a retirement account. I don't think it is.
I appreciate that so much. And you can please correct me. I know you will correct me if I'm wrong, but I always remind people, even if we're, depreciating and we're using that to offset, we're not deleting, we're just deferring.
Exactly. Yeah. Cause you have depreciation recapture when you sell. Mm-hmm. And so it's a tax deferral mechanism. That's a great point. It's not tax elimination, which if you think of a Roth IRA or even a Roth 401k for people with solo Ks, I mean, those are tax-free. Like you can do a deal in it, and I have lots of examples. I teach at my Self-Directed IRA Summit. These totally tax-free, and I have these clients. I have one of them that speaks at my Self-Directed IRA Summit. My next one, by the way, is in Dallas, SDIRAsummit.com, little commercial plug there. But it's in Dallas, April 19th to 20th. But one of my board members, he's been a longtime client of mine, large Roth IRA account. But I mean, he just loves this thing because he's in his 60s now. And he's like, it's a tax-free ATM. He's like, every deal I do in this thing, I can pull the money out tomorrow because I'm 59 and a half now. And he's like, but you know what? I paid the dues in my 40s and 50s to build this thing up. And now I got this little tax-free ATM. I can do big deals, little deals in it. And it's this awesome strategy. So there's different ways you can look at a self-directed IRA and the benefits of it. One is just what I was preaching a moment ago, which is just use a self-directed IRA to get a bigger return than you could get in the stock market. You're like, I got 200 grand into my IRA at Charles Schwab and it's not getting a great return. And you're like, I could make more by doing real estate. We'll do that because that you're going to get a higher return, have a bigger retirement account at retirement. Another reason some people use it, this will be with the Roth crowd in particular, is because it's a tax strategy. They're like, I'm a deal maker. This is most of my entrepreneur real estate clients. They're using Roth accounts to cut deals, to flip a property, to wholesale a property, to option a property. And they're making big scores. This is what my client will do. He talks about it on stage. He's from Rhode Island, so he calls it a score. You got a big score. You got a big score, Matt. He's awesome. Anyway, so, but so you can get these big scores, so to speak, in your Roth IRA that are totally tax-free. Now, if you're like, well, man, I'm in my 40s, how's this getting me excited? Well, this is accumulating, and at 59 and a half, you will pull this out totally tax-free. And so it can be kind of this tax-free strategy using Roth accounts for specific deals if you're a deal maker too. So there's lots of different ways people get to this self-directed strategy and why it benefits them. And it kind of depends on the type of investor you are, the deals you have. Are you chasing that tax-free type income? Are you trying to get a higher yield than what you're getting in the stock market? I mean, there's so many different things to talk about there, but everybody has their little differences of why they're doing it. But I think those are the two big ones: is trying to get a higher yield, using Roth accounts to get tax-free returns.
This is really, really critical. I'm going to give a statement, I suppose, and ask a question. And I know
Yeah.
that we're going to need to wrap up, but this is such a critical topic, and people, there's so much misinformation out there on this topic that this is really important. So conscious investor, again, I've said it before already in this episode, but make sure you go out. There's so many great resources at directedira.com. Go check them out. I mean, Matt has 2 different podcasts. There are downloadable resources. There are links to events. There's so much opportunity for you to not get caught in the hustle and bustle of things. So just make sure that you are doing yourself a service. Okay. I want to ask this final question, Matt. And this is what I notice happens is that the grass is always greener on the other side.
Mhm.
Well, especially the entrepreneur spirit, we're like, look at that. That's working for them. Oh, that's working for them. Oh, that's it. And we squirrel, like, especially young entrepreneurs. And that doesn't mean conscious investor. That doesn't mean that you're young in age. It just means that in the entrepreneurial journey, you're still maturing. And so you could be a betweener, someone in your 40s and 50s, just learning, and you just keep changing the strategy. So what would you say are some tips on determining, okay, no, I'm chasing after yield and that's what I'm going after, or
Mhm.
I'm going to chase after, I'm going the Roth direction and I'm going to say taxes are on sale because they're going to go up and I'm going to pay it right
Yeah.
now. How do we do this so that we get focused? Because if we squirrel away, we're going to waste away.
I hate to say it, but I'm gonna be a little contrarian here. I'm like, go your own way.
Yeah.
Go your own way. There's not one way to do it. There is not one way to do it. I think of the largest accounts I have, they're all doing freaking different things. They're not doing the same thing. Some of them are just chasing yield. They don't care about taxes and using a Roth account. They're just in higher income producing assets than what they were in the stock market before they came here. Some of them are very savvy. They care about the taxes and they're hung up on it. They hate the government, and they're like, I'm using my Roth account. And I love that too. I mean, I like that. So, and they can have a big account too. So one thing I think that's very dangerous is people think there's one way. There's one way to build wealth. There's one way to have a big retirement account. And I think that's totally BS. It is different for everyone. And there's a lot of different ways to get to the same point of feeling like you have a retirement account you can actually live on and be excited about hitting 60, 70 years old and living off of this thing. And so I would just challenge people to be confident in what their decisions are, but you need to be educated too. And I think this will be probably if we're wrapping up here, this will be my final takeaway is from my experience, sitting on the outside, watching tens of thousands of plus investors. I've done the 1,000+ consults. I got the 10,000 hours of talking to people trying to build wealth. Probably one of the biggest things I've realized is there's 2 categories of people. There are people that just go a million miles an hour. They don't understand what they're doing. They get excited. They're that entrepreneur you were talking about. They're distracted by everything. They're trying a million things. Every once in a while, those ones nail it. And they're super successful. And we all look at them and we're like, how the hell did that person, they look like an idiot. They sound like a moron when I talk to them, and they're super successful. That's because they went for it. Now, I will tell you, because I've talked to the other 9 of the 10 of those that crashed and burned and are in bankruptcy. Okay. We see the good ones and the bad ones. And so there's some of them fail, some of them hit it. On the other hand, I have another set of clients than people that I talk to that analyze things a million times. They read every book twice. They go to every every conference. They watch the recording of the conference when they get back. They study, they analyze 100 deals, and they don't take any action. They don't do anything. And so, but both of those people can be successful. If you're the person that analyzes stuff to the 10th degree and you don't do anything, be aware of who you are. You're like, I'm that person. I need to freaking take action and recognize who you are and get in the game finally. You know what I mean? I remember I had this one client, I've been talking to him for like 4 years, and he like analyzing deal after deal after deal. And he's like telling me, I just don't know if I should do this one. It looks great. And, it just looks, the numbers look a little tight on it. And I'm like, what's the one you showed me 4 years ago you didn't do? Go look that one up. And he's like, I would have crushed it if I did that deal. I'm like, see what I'm talking about? This guy was an engineer. He had everything dialed in, and every number had to be certain, and every calculation had to be right. And he just like overdid it. So, but know who you are, realize I need to take a little risk. I need to kind of get out of my comfort zone a little bit, have some confidence in what I'm trying to do. On the other hand, if you're that entrepreneur that goes a million miles an hour and you won't read anything, you'd hardly take anyone else's advice. You're a people person, you go a million miles an hour. Great. Recognize that, but realize you're going to be so much more successful. Your focus, your energy is going to be so much more challenged if you freaking took a minute to learn some stuff that is going to protect you and you're going to have a greater likelihood of having success. And so I think that applies to anybody that's a business owner, investor in general, and self-directed investors is know who you are and then realize that as you're out trying to make investment and business decisions. I think it will greater increase your likelihood of success.
I echo everything. By the way, Conscious Investor, I'd highly recommend go check out episode probably 455 or so. It's about Goliath, like fighting your own Goliath. And really it's the thesis is it's a shared heartbeat of, you know what? You got to do what works for you. Like know who you are and then operate within that construct. Like don't try to be the person that you're not to say, okay, great. I don't like taking risk, but I'm going to have to take a level of risk, calculated measure risk in order to have the success I'm looking for. Or I'm going, like you're saying, 100 million miles an hour. But if I really want to be successful, I'm going to need to harness that and really focus it in so that I can be successful. It's like really, truly understanding and leveraging the best qualities that you have so that they're assets, not liabilities.
Yeah. Love that. And some people learn it after crashing and burning. Some people like that, the entrepreneurs, seriously. And that's why you look like a Jeff Bezos, like super successful. Well, not on his first business. I mean, Amazon was like his 10th business. He failed on so many more to get there, but he eventually had to learn that. He learned all the hard lessons, then he got there. But then on the other hand, I talk to people in their 60s that have no retirement built for themselves because they've been so scared to do anything. And they just haven't taken any action on anything. They're super knowledgeable. They read the Wall Street Journal every week. They listen to the news. But they don't do anything. And so anyway, so just know who you are. Try to get off of that, whatever disadvantage you have, and turn it into an advantage for yourself.
Love it. Conscious Investor, you need to head up north to North Idaho to the Coeur d'Alene Resort for the Conscious Investor Growth Summit, because Matt is going to be speaking there, which will be super fun and amazing. You'll be able to ask questions. And guess what? He won't be charging by the hour. And I just said that.
Yeah, I'm excited for it. I've heard about Coeur d'Alene. I've never been. So I'm excited to be there. And I think, I don't know, what do I need to pack for this? Anyways, I'm excited to be there. And I'm excited for your event too. And for the community you've built and everybody, and to get to meet everybody up there.
It's going to be phenomenal. And I'm just absolutely thrilled that you are coming up and your willingness to just pour into, the conscious investors that are showing up. And so many of them are excited, to see you there. You're going to get, like all your fans. So
yeah. Yeah. Well, I love it. I'm excited for it. Thanks so much for inviting me. It's an honor to participate.
It's amazing. And I'm so grateful. Conscious Investor, you need to run down to the show notes where if you're on YouTube, if you're on, listening on whatever platform you are on, make sure go connect up, follow Matt's podcasts right now, because what happens a lot of times is we listen to some really great content and we're like, oh, that was really great. And we get distracted. So you don't want to be distracted. You want to make sure that you go right now to the show notes, that you click on the link, go subscribe, follow whatever platform you're on, Matt's shows, so that those are coming into your feed to nurture you on this specific topic, because it's not a topic you want to make mistakes on, number one. And number two, it's really fun when you get it figured out and you're doing things the right way. So when you have the right guidance, you can take those calculated risks, or you can zero yourself in with confidence. And plus Matt's super fun. And I like to do business with people for fun. So I'm like, hey, you know what?
Exactly. Life is short. You might as well have fun doing it too.
You got to have so much fun doing it. Matt, thanks so much for your time, for pouring into the Conscious Investor. And I wish you the very best afternoon.
My pleasure.
Conscious investor, one last thing. Remember, adventure belongs on the trail, not in your investing, not in your personal life. So, don't be a stranger. I'm here. I create content to serve you and support you. So feel free, head on down to the show notes while you're there following Matt's show. Just go back down to the show notes and schedule time. Let's have a chat conversation. Until next time, live big, love bigger, and do great things.